Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The following program is pre-recorded. Listener calls are not being taken at this time. Thanks for listening to AM 1420, The Answer. Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Welcome back. Boy, it seems like every time I turn on the news, I'm turning it right back off again. It's just a tremendous amount of bad news. It's really, there is a lot of good news out there. It's just that media is not covering it. And, it doesn't sell ads. That's the number one reason that they don't cover more good news. It just doesn't sell as many. I shouldn't say it doesn't sell any ads. It doesn't sell nearly as many ads as tragedies do. And Lord knows there are enough tragedies to go around to keep them busy 24/7. I bet they wish that the days would last longer than 24 hours so they could generate more revenue. But that being said, I'm looking at the stock market. When you look at what's going on and you look at the funds are not down nearly as much as you'd expect them to be with all the things that are going on right now. In fact, it was down way more, much quicker during the pandemic than it is today. And today you still have the pandemic, but we've also got World War III on our hands. That didn't exist back when it was just COVID. But it exists now, and markets have not gone down quite as much. They're down quite a bit. Actually, they're right to where they were before they dropped in March of 2019. And I know that's very painful for a lot of people. They look at that and they go, oh, I've wiped out 2 years worth of gains. Well, you know what? That's actually how the market actually works. That's why its long-term returns are so high, because you pay for that. With the volatility, with the fluctuation up and down, it's going to happen. It's never not been that way. In fact, it was worse before people had 24/7 access over the internet. The average investor's performance has actually improved slightly, ever so slightly, over the past few years. But it's always been very, very emotional. It doesn't really rely a lot on cash. And we're going to talk a little bit about all the things that are going on that are positive, because there are a huge number of positive things that are being developed right now. The developments, they're not stopping. That's the one great thing about humanity. They're motivated to improve. And anybody that is under the age of 20 that doesn't know that just hasn't been watching really closely. And if you're the older you get, the more you see all these problems. I was too young to remember this, but I've read about when there were actually nuclear missiles aimed at the United States in Cuba. Now, did you know that people have actually managed to swim from Cuba to the United States? So that's how close those nuclear missiles were. And they're pointed right at us. And so you want to talk about trauma and drama. And President Kennedy sent some warships down there and said, if you don't get those off right now, he's going to obliterate the whole island. And, they backed down. They pulled away. So my point here is that this is not the first time that we've had this sort of thing. And even though that was a really long time ago, it was 50 years ago, we had conflicts in Vietnam, then we've had the Middle Eastern conflicts that have come in the late 80s, 90s. That kind of stuff is always upsetting. So you basically have to train your mind. You have to train your mind not to pay attention that, things are down now, but they'll come back. When you look at how quickly the market's recovered in many cases, in a lot of cases, the market will recover all of its losses in a relatively short time period. That is actually unique to the last 25 years. Prior to that, recoveries were a little slower, but they've been recovering a little bit quicker. In fact, it's pretty mind-boggling. If you go back to 2020 and you look at where the S&P was and how far down it dropped, it was almost 40%, almost a week. But then, let's see, it's 1, 2, 3, 4, 5. Look at my calendar here. 6 months, it had recovered the entire drop. 6 months. Okay, so, and that's kind of, one of my points is that markets are going to recover, so I wouldn't worry a lot about it. If you're worried about it, just give your financial advisor a call. That's what we're there for. It's basically as a coach. A coach is a very necessary thing from time to time. It works out really well. And I've got lots of coaches. It's called books. I've been in the business for a long time. I'll never forget. I worked at Fidelity at one point in time and was able to pull up. I probably shouldn't be saying this out loud, but I pulled up Peter Lynch's accounts, his personal accounts. Peter Lynch, if you don't know who he was, it's because he's been retired for so long. But look, Google the guy. He was one of the best stockbrokers ever lived, and if not the best. So I'm looking at his portfolio, and this dude was, when he was down, it was down. He just had no fear. And some of the stocks that he was holding on to, they'd be down like 80, 90%. I was like, what? And the more I got to know about it, the more I realized, that's actually normal. So if you're not going to get the really big returns without an awful lot of fluctuation. And today, what's kind of unfortunate about today versus the way it was when I first entered the industry was you could literally get 10% CDs, and I had missed the peak. I think they peaked out somewhere around 15% or so. But you could still get a 10% CD when I first got licensed as a stockbroker. Back in those days, they didn't call us financial advisors. And so anyway, you could get a 10% CD. High yield bonds, those are, the slang for that is junk bond. Those are below investment grade. I really liked that category for an awfully long time. I still like it. It's just, it's harder. It's not as good of a deal as it was back in those days. And in those days, you could buy high yield bonds. They were paying 12, 13%, 14%. It was amazing. And you'd look at some of the companies, and they all were covering their interest expenses by 2 or 3 times, still considered junk bonds, mainly because of the size of the debt that they held. But you're getting a 12, 13% interest rate on a bond. That's mind-boggling. If those days were today, that'd be awesome. By the way, all those bonds have been called, and now people are looking at interest rates that are in the actually somewhere between 2 and 2.5. Generally, you can get CDs for that. You can get treasuries for that if you can't get a CD. And there are a lot of bond funds that invest in super short-term bonds. Their yields are still more than 1%. That's the current yield. So it's been creeping up. If interest rates keep going up, that's going to keep creeping up. But the rising interest rates has caused the perception that economies are slowing down. If you look underneath, the actual statistics are not bad. The supply chain's doing more damage than anything else. And it's not really the inflation rates. And the inflation rates are caused mostly by the lack of supply. And think about it. If you can't get something, the people that are selling it who make their earn a commission, Amazon gets a percentage of everything that they sell, but if they can't sell it because they don't have it in stock, that hurts the company's sales and profits. And then the Fed comes and says, oh, we know how to fix that. Let's just raise interest rates. And I'm like, I don't know about this one. I mean, I really like Powell a lot. Governor Powell, the guy that's the Fed, head of the Fed. I like him a lot. Jerome Powell, not governor. I might be from England. Governor? I don't think so. Anyway, but I just this is the only time that somebody's done something, in response to high inflation. And I could see if it was a demand, just the demand was going crazy and people were spending down all their money and they're not saving any money. Yeah, then raising interest rates in that environment, that should probably happen. But when rates are going higher because there's a lack of business, and when the business slows down, you have to raise interest rates on mortgages, or if you can't get, because the supply is dropping off, I don't know, raising interest rates, that's going to increase the supply? You got me. So it doesn't really make sense. When they say it's different this time, and I know you're probably sick and tired of hearing me talk about that, or using that phrase, but it is really different this time. There are so many things happening at the same time, and thankfully we can watch every single minute of it because there are hundreds of channels that produce this stuff 24/7. So you can stay right on top of it and make you feel really good. I'm just kidding. You have to kind of you really have to be pretty strong to remain positive in this environment. And I think it's important. This is not, anything that's happening right now is nothing that we haven't seen before. It's actually how we got here. And we'll probably see all these things play out again in the future. My grandchildren, by the time they're my age, will probably be seeing this play out on other planets. Yeah, because that's where we're headed. We're trying to go out other planets. And I think it's really interesting. And by the way, that reminds me, there's some technologies that are being trying to be introduced, and I hope they make it. I mean, I really hope they make it. You never know for sure, but it could be some huge game changers. And I think I'm getting close to a commercial break here. Hey, if you hear anything that you have a question on or would like more information on, you can just go to my website, bullingtoncapital.com. I'll try to get back to you as quickly as I possibly can. And I see a bright future. You might want to see some of the illustrations that I have. You have to request those, and I have to have contact with you. By the way, the license that I have for that material, I have to be in contact with you personally, and I can't send it out to the masses. That's basically the bottom line. So, and we'll talk a little bit more about that when we come back from these commercial messages that are about to show up here and keep the radio station in business. And that's a good thing. That's a really good thing. So, by the way, this show is carried as a podcast. You can actually go to my website and pick it up there. So if you heard something and you wanted to remember or hear it again, you could always go there and pick it up on the podcast. Yeah, not sure why I do that. I can't stand the sound of my own voice, but anyway, I hear the music. That means I got a commercial break. This is Bill Bullington right here on 1420. Stay tuned. I will be right back.
This is for the lost and lonely, for the broken and afraid. This is for those who are hurting, hoping help is on the way. In these battles of addiction,
Now that I've got your attention, let me tell you all about us. Whoa, tough crowd. Anybody out there? Hello? Anyone?
Fighting to be heard in today's competitive digital world?
It's time for Salem Surround. Let us handle everything and get your message seen and heard.
Let's turn up the volume on your business with Salem Surround.
Visit surroundcleveland.com today. That's surroundcleveland.com.
In the old Dracula movies starring Bela Lugosi, all you had to do was show the cross, and the vampire would slink away. Well, we still have that cross. Only this time that cross represents the truth. We have truth on our side. Truth, common sense, and the belief in what's right. Use the truth to win those arguments. And stay tuned to this station to find out what's real, what's true, and who's telling the lies. That's why we exist. AM 1420, The Answer.
And Odyssey.
From an idea that started in 1967, Our Lady of the Wayside has grown to serve almost 900 children and adults with developmental disabilities throughout Northeast Ohio. It's an operation that is still growing thanks to tremendous support and generous donations like the Wayside's car donation program. You can donate your ride to the Wayside for a great tax write-off by calling 1-800-368-6262. The Wayside is also looking for people to join their team. They hire for attitude and train for skills. Visit thewayside.org to apply today.
Do you ever find yourself saying, I need a vacation? Vacation Fixation can help. At Vacation Fixation, we specialize in all-inclusive trips and cruises to Mexico, the Caribbean, and Disney vacations. Why choose us? Our clients book through Vacation Fixation because they are frustrated with online trip brokers and timeshare scams. Whether it's a weekend getaway, a family trip, spring break, or honeymoon, Vacation Fixation will personalize a trip just for you. Want to know the hottest destinations in Cancun, Punta Cana, Jamaica, or Puerto Vallarta? Interested in room upgrades, beach reviews, or details about resort restaurants? How about finding a trip with a direct flight? At Vacation Fixation, we take all of your specific travel requests and shop our suppliers to find the best deal. What's the cost? Our suppliers pay us so you don't have to. Call 330-573-8147 for more details. Or you can visit our website at vacationfixation.com or check out the deal of the day on Facebook. Vacation Fixation.
Is it finally time to update your bathroom? Bath Planet, a division of Joyce Factory Direct, specializes in replacing and converting old showers and tubs into new, beautiful bathrooms in as little as one day. We have transformed thousands of bathrooms just like yours into a spa-like oasis that has homeowners excited to use their new bathtub or shower. Right now, all bath installations are 50% off. So call to schedule a free consultation with on-the-spot pricing. 440-243-5700 or visit JoyceFactoryDirect.com.
Joy that I cannot deny. The holy fire that makes me come alive. It's a love that I can't hide. It's burning deep inside. Wherever I go, wherever I go, I've got that.
And we're back. Hey, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. If you'd like to re-listen to this for some reason, you can go to my website, bullingtoncapital.com, or you can find it on iHeart, the iTunes. And if you have questions, please feel free to call me during the week or send me an email, and I'll try to address them on future shows. That always helps. Sometimes it's pretty difficult to come up with new topics when you've been doing this for as long as I have, but not really. Actually, things are constantly changing. When you think about it, look at the interest rates. Look at where interest rates are now versus where they were just a few months ago. And they've been coming up. Treasury rates are getting much, much higher. You got a one-year treasury. Anything that's super short-term, by the way, that's where you should be right now. If you're investing in bonds, you'll notice that most of your bond funds are down this year in double digits. About half as much as the stock market is, but actually, no, it's been about 3/4. So that old, I was just talking about this with one of my friends in the industry, and we were talking about the yield curves. Basically, yield curve is a graph. A curve is a graph, by the way. And the shorter the treasury is, the lower interest rate it's supposed to be. When you have a yield curve that's flat or inverted, that means the short-term bonds are paying more than long-term bonds. Well, we haven't gotten to that point. We haven't been there since the early 1980s. But they keep talking about that as if it's going to happen again. I'm telling you. I mean, it could happen again, and I might run a sub 4-minute mile. I don't know. I doubt it. Actually, it's got a much better chance. An inverted yield curve probably has about as good of a chance as the Browns going to the Super Bowl. Okay, now, I didn't say they're going to go undefeated. I said going to the Super Bowl. And that's about the odds or the probabilities that I would give that the 1 or 2 year Treasury is going to be paying an interest rate that's higher than the 30-year. That's called an inverted yield curve. And they say, there's always a recession. Well, see, that's happened so few times. There's this thing in statistics, like it's called the sample size, like how many times it's happened. And normally it's got to be a lot more than 2. 2 could be just a coincidence. And when you understand the reasons why that stuff is happening, I'm just being facetious. It's been slightly more than 2 times. And the yield curve doesn't control the economy. The Federal Reserve is setting the yield curve based on what they see and how they interpret things. Okay, so I know it all sounds super complicated, and that's because it is. But I'm just telling you that an inverted yield curve by itself is not very meaningful. So when short-term interest rates are higher than long-term interest rates, you know what? It's probably because we have rapid inflation, and they're trying to stop it. They're trying to put a stop to it using interest rates. Interest rates, by the way, are not nearly as effective as using reserve requirements. If the Fed requires banks to have more money on reserve for emergencies, that is super effective. Or if the Fed sells a lot of bonds instead of buying bonds, that's effective. They're controlling that's like the spigot of a hose. You know, you turn the hose on, turn the spigot on, and it eventually comes out the end of the hose. Well, that spigot are the reserve requirements. You start raising the reserve requirements, the spigot's closing slowly. It's slowing down the trickle of money flowing through the economy, and that is super effective. If you use both interest rates and raising reserve, by the way, at this point in time, I'm pretty sure they're afraid to do that. If they started to raise reserve requirements, that's how interest rates got so high in the early 80s, because they made the banks hold back more money in reserves relative to what they had done prior to that. So anyway, when they increased the amount of money that the banks got to put in reserves, it lowers the amount of money that they have to lend. So on those loans, they're going to have to raise interest rates, and they're not going to be able to make as many of them because there just aren't that many available. The reason they have to raise interest rates is they don't have enough money, or they have less money to make money on going forward. Does that make sense? They had to keep it in reserve. So they can't lend it out. They've got not as much capital to lend. So therefore, on the capital that they do have, they're going to have to raise the interest rates to make up for the difference. And that's what really makes a big difference. If they raise reserve requirements, then you're probably going to see a period like 1978 through 1982. And you want to talk about volatile. Go look at a long-term chart of that. And when I can, I think this week sometime, we'll set a seminar for sometime in September. And I'll show you all this stuff, because it's one thing to say it and listen to it, but it's another thing altogether when you can actually see the graphic, and the graphics are not complicated. The concept itself is not super complicated. You can make it as complicated as you want, by the way. But the bottom line is, when they start raising the reserve requirements, if they ever get, that's really heavy-handed, by the way. Just raising interest rates by itself, that does have an impact. It actually disqualifies some people from being able to qualify for a mortgage. When they raise the interest rate, it raises the payment on the mortgage. and raising the payment on the mortgage, they're only going to qualify based on whatever their income is. The bank's not allowed to loan them past a certain level. They don't want them spending 70% of their monthly income on a mortgage because they won't be able to afford to live. They won't be able to afford groceries. And so if they raise interest rates, those payments that go up, and as a percentage of their income, if their income has not increased at least as much as that is, then you don't have as many people qualifying for loans, and therefore business has a tendency to slow down. So that will have an impact. It does have an impact. It's not as great as we can't make the loan because the Fed requires us to keep more money with them. Or in reserve. That is highly effective. And in the banks, you'll see interest rates skyrocket. That's actually what happened in the 78 through 82. And, it was effective. You put the economy into a severe depression, and it actually helped break OPEC. That was one of the big parts of inflation at that point in time. They were, I think I saw gasoline prices go from it was like 35 cents up to $1.30 and $1.40 a gallon. And I know that seems like super low, and I'm giving away my age here, but I recall that because we had this big old car that only got about 8 miles a gallon, and I had to put the gas in if I wanted to go on a date. That was probably half the cost of the date was putting the gas in the car. So I remember that very well. And I remember what happened when they started reducing the reserve requirements and interest rates started to go down. The economy exploded. It was growing the entire time, but inflation was making it very difficult for a lot of companies to raise their prices quite as fast as their costs were going up by. And then they started dropping. So what does all this mean for the investor? So for an investor, what it means is you probably should have already planned for this. If you've got an investment plan, it should include this. And you should be looking, if you're trying to get a plan together, at investing in stocks, getting a certain percentage of your money in stocks based on volatility, and I'll get to that in a second. But and you shouldn't be trying to guess at when you're going to make adjustments. That should be done ahead of time. There should be no, should I do this now? Because when you try to do that, you are trying to predict the future, and you're trying to predict what time the market's going to move, and that's called market timing. And just Google market timing and how successful some people are. By the way, if they're selling a course, nobody who's successful at market timing sells a course in it. Okay, they don't need to. And that's how few of them there are out there. And they wouldn't give those secrets away. And they wouldn't need to. They would be making so much money doing it. And there are some, they're called high-frequency trading firms. They're not actually market timers, but they make money trading short-term. They're the only ones. And what they're doing, you got to have billions of dollars to do. So, if you don't have billions of dollars and a whole lot of time and willing to invest billions of dollars in the infrastructure to get that accomplished, don't do it. Come up with a plan. Look at how much risk you're willing to take overall. When I say risk, I mean what kind of a decline in your portfolio are you willing to put up with? If you're willing to put up with a 25% decline, don't put more than 50% of your money in stocks. Put the other 50% in something that's relatively safe, or at least safer. Okay? So let me say that again. If you are willing to put up with a 25% decline, put half your money in a diversified stock portfolio. We'll get more to that in a little bit. But invest in stocks. Take the other 50% and put it in something that's safer. Something that's not going to drop 50% or more when the markets are going down. Okay? And it's that simple. Take whatever decline you're willing to put up with. I'm willing to put up with a 40% decline. No problem. So I've always got 70 or 80% of my money in some sort of stocks. Okay, mostly funds, mostly exchange-traded funds, actually. So that's me. I'm willing to, if I'm down 40%, I'm like, oh, man, I don't like seeing it, but I understood that it could happen. Okay. And so I'm willing to put up with it because I really would like to average my average annual return somewhere in the high single digits. And I know a lot of people are looking at it, they go, oh, man, I'm going to get 20% a year. Yeah, good luck with that. That's all I have to say. Good luck. I know it doesn't sound like it should be that hard to do. It is, especially when you've got a lot of money. When you've got a little bit of money, not as difficult. Okay, that's nowhere near as difficult. You're still taking an incredible amount of risk. And investment management is really more about controlling your risk than anything else, because the amount of risk you're taking is going to have a huge impact on your total returns. So if you're not a big risk taker, give up the idea of making huge returns. It's just not going to happen. You can't take the risk. And a lot of people shouldn't be taking that kind of risk. I like to say there's the risk that you're taking right now. There's the risk that you should be taking. And those two are incredibly different in many cases. So actually, it's one of the reasons I have a job. The vast majority of people have no idea how much risk they're taking. And I can look at your portfolio in about 10 minutes and explain it to you. So again, if you want to reach out to me, because you say, I'd like for you to take a look at my portfolio and tell me how much risk I'm taking. No problem. That's in fact, it only takes about 10 minutes. So I'll be glad to do that. And I just got I think a commercial break is supposed to come up here in a few seconds. But again, if you want to reach out to me, just go to my website. It's bullingtoncapital.com. You can also call us in the office, 330-664-0700. I forget to give that number out a lot. A lot of people don't. This day and age, a lot of people still don't like to use the internet. That's fine. That's absolutely fine. 330-664-0700 is the number. And I'll be glad to try to get back with you and answer your questions as quickly as I possibly can. And other than that, I'm just kind of hanging out here waiting for the commercials to start. There they are. Hey, this is Bill Bullington right here on 1420. I'll be back right after these messages.
Only way I'm getting to the other side. Days are getting dark, life's a little hard. Blinded, but I'm trying not to lose sight. I don't got this, I know you got this. Yeah. And I believe it before I see it. Yeah. I know you're gonna see me through it. If anybody can, you can do it. Gotta know in the trial, in the pain, fire, in the rain, you're gonna see me through it.
Do you ever find yourself saying, I need a vacation? Vacation Fixation can help. At Vacation Fixation, we specialize in all-inclusive trips and cruises to Mexico, the Caribbean, and Disney vacations. Why choose us? Our clients book through Vacation Fixation because they are frustrated with online trip brokers and timeshare scams. Whether it's a weekend getaway, a family trip, spring break, or honeymoon, Vacation Fixation will personalize a trip just for you. Want to know the hottest destinations in Cancun, Punta Cana, Jamaica, or Puerto Vallarta? Interested in room upgrades, beach reviews, or details about resort restaurants? How about finding a trip with a direct flight? At Vacation Fixation, we take all of your specific travel requests and shop our suppliers to find the best deal. What's the cost? Our suppliers pay us so you don't have to. Call 330-573-8147 for more details. Or you can visit our website at vacationfixation.com or check out the deal of the day on Facebook. Vacation Fixation.
Now let's be honest.
Aren't we always honest? We say we're straight-talking plumbers.
I meant bluntly honest.
Okay, gotcha.
If you're a first-rate plumber, you can write your own ticket to work anywhere you want.
And we want you for why it works.
So here's why you should choose us. 1, no on-call.
Because family time is sacred.
2, family first, and we'll work with your schedule.
What good is raise a family money without quality time with the family?
3, we've got a truck waiting for you.
And it's a sweet rolling warehouse of a truck.
4, mom's breakfast every Tuesday.
And it's so good.
6, we're growing, and you can grow with us.
You want to move up? You can with us.
7, we'll teach you to Wallackadoodle.
And we'll teach you how to spell it.
8, no on-call.
You already said that.
Well, because it's important. 5, work with the best plumbers and for the best customers in Cleveland.
Oh, that is a biggie.
Yeah, I should have put that first.
Or at least between 4 and 6.
Anyway, if that sounds good to you, hit us up at
WyattWorks.com.
License number 30185.
No doubt about it, we're spending more time at home, which is the perfect time to make it more functional and beautiful. Hi, Ed Flash Ferentz here for Artistic Renovations, Northeast Ohio's premier and award-winning remodeler. Artistic did a fantastic job with our kitchen in 2016, and last year, they were back for the master bath. Oh, my word. Do yourself a favor and go to artisticreno.com. Believe me, you'll love their ideas and without question the finished product. For a virtual consultation, call 216-520-0838 or visit artisticreno.com.
Thinking about updating your home? Well, Joyce Factory Direct specializes in replacing old, outdated windows. Proudly made right here in Cleveland, Joyce Windows features their exclusive Smart Shield high-performance glass, which means you'll be getting the most energy-efficient windows for your home directly from the factory. Customers just love how much warmer their house is and how easy their new windows operate and clean. Right now, you can save 50% on all installations. Just call to schedule a free consultation with on-the-spot pricing, 440-243-5700, or visit JoyceFactoryDirect.com.
Looking for a great way to save on taxes? Look no more. Just call Our Lady of the Wayside at 1-800-368-6262 and ask about their car donation program. It's simple and it works for everyone involved. You donate your ride, you write off the selling price, and the money goes to help the physically and mentally challenged citizens served by Our Lady of the Wayside. The number to call, 1-800-368-6262.
Well, you want more, so get more. Donate your ride to Our Lady of the Wayside.
AM 1420 is Cleveland's answer for news, opinions, and insights. Listen online at WHKRadio.com.
I heard your heart, I see your pain. Out in the dark, out in the rain. Feel so alone, feel so afraid. I heard you pray in Jesus' name. It may be midnight or midday. It's never early, never late. He gon' stand by what he claimed. I lived enough life to say help is on the way. Round in the corner.
And here it comes. Help's on the way. Hey, I was just looking at, there's a bond fund that invests just in long-term treasury bonds. And minimum maturity, I think, is 20 years. Just to give you kind of an idea of what's been happening. So if you look at from the beginning of the year, go back to, let's go into January, that bond fund is down about 20%. I mean, think about that for a second. Those are 20-year government bonds. That's why it's so important to understand this. If you're in a shorter-term bond fund, it's not down anywhere near that much, probably less than half. And if you're in if you were in that bond fund since 2020, as interest rates have started going up, the bond fund that's holding U.S. Treasuries is down 33%. Think about that for a second. 33%. That is really, I mean, to make that up, and I think the yield on that fund right now is about 2%. And back in 2020, it was about 1.75, somewhere in that neighborhood. You may not live long enough to get your money back there if you didn't spend any of it and you reinvested all of it. So you have to be careful. And one of the funds that I used, one of the short-term funds over that time period, it's still down a little bit, but because it's gotten the yield, it's actually got a positive return. Big difference. Not that they don't go down. All bonds fluctuate a little bit, but this one fluctuates very little bit. It's actually down 2.5%, and because it's been paying a rate of return, that's variable too because short-term interest rates change. And right now, I think it's about 1 3/4, somewhere around there. But anyway, you would not be negative at all. You would have just kind of treaded water, which is a whole lot better than being down 30%, or 29%, or 40%. If I measure from the peak to the trough for the long-term treasury bond fund, it's a 40%. From where it peaked out to where it bottomed out is literally 40%. That is mind-boggling. I just didn't think you'd see that wide of a swing over that short of a time period, and that's what I get for thinking. But I haven't held on. I haven't invested in the TLT for an incredibly long time period. And I remember a guy called in a few years ago talking about it because it was going up, and I just hope he didn't hold on to it. I didn't like it back then because I knew higher interest rates at some point in time were likely to appear, and predicting that is like predicting the stock market. And if you think you can predict the stock market, you just haven't been around long enough, or you're just very stubborn. One of the two. And there were some, I know back 15, 20 years ago, there were some pretty sophisticated methodologies you could use, and it would tell you when markets were changing, when things were getting rougher, and you could see that. You could observe it, and you could make adjustments. Well, that stopped working, probably 7 years ago, 6 or 7 years ago. And I'm pretty sure it's because you had so many exchange-traded funds. These are funds that are run by computers. They're not, they're emotionless. The investors, by the way, are putting money in and out of those funds instead of putting them in and out of individual stocks. So the volatilities are incredible. The amount of money that's been printed worldwide has been growing significantly. So the available dollars to push those prices higher has increased a lot. That also contributes to the volatilities. And so things don't work exactly like they did. And I think the adjustments that you can make are good ones now. I think you've got really good options. I think a fixed indexed annuity, which I haven't spent any time talking about today, with the kind of returns that it will guarantee for you, and the way that most people have performed in their investments, I think they make a great idea, for the right person. They're not for everybody. I know people that are extremely successful in stocks because they've got 60 or 70% of their money invested in stocks, and they're organized. That's the one thing I really like about ETFs. They are organized. You can read exactly how the money is being invested, and you can look up all the stocks in the fund. You couldn't do that when I first started in the industry. So you can get a really good idea of what to expect. Now, it's still hard when they're down. And that's why these fixed index products, I think, are so important, because the returns that they're willing to guarantee somebody, and the guarantee is only as good as the underlying insurance company. And so you got to be careful there. Keep that in mind when you're making the investments. And I can't emphasize that enough. If you go in really hard times, super hard times, and the insurance company's not well managed, you could end up taking a loss there that you didn't expect. Okay. But for the most part, I really like them. And they are, you get guarantees by companies that have been around almost as long as this country has, for more than, a century. Some of them are a little newer than that, but they have rating agencies, so you can look to see what the rating agencies think about their ability to pay, and that helps. But what really helps is that their current income levels, or the income, like I have one, I'm going to turn it on because, knock on wood, the full Social Security age is still only going to be 67 when I get there. It'd probably be 70 by the time I get there. And that's okay. I'll just keep the product. When I qualify for full Social Security, the money that I have there plus my Social Security, I'll be able to live on that. I won't need any of my other assets. So that's pretty cool. And the other assets are going to be there for inflation, because that's the other thing. If you're in your mid-60s and you're doing this, you probably shouldn't put all of your money into it, because you're going to need to invest something to keep up with inflation, and that's going to probably require stocks. Now, it all depends on how much money you have. If you have more money, you can be more conservative. You don't have to worry about it. That's one of the toughest parts, I think, about financial planning. Okay, how much risk am I going to have to take to be able to reach my goals? That's kind of a key question. And I've never seen that in any financial planning material that I've looked at. Now that I've said that, and this goes all over the internet, maybe we'll get to see that. How much risk am I really going to need to be able to meet my financial goals? Now, incidentally, I saw an article that was kind of close to that. They almost got there. And it was in one of the big major publications that's extremely popular and very influential. And they were using long-term bond numbers that were showing 6% returns for bonds. Okay. Long-term bonds have not produced 6% for over a decade. And this article was recent. And they were using the return from bonds going way back into the 70s. I'm like, yeah, probably not a good idea. Okay. And not only are you going to disappoint your readers, magazine, if you're listening, you know who you are. You're going to disappoint your readers. You're going to make people super upset because they're going to go into it expecting to get those types of returns, and it's probably not going to happen. And that's the problem with making projections. It's think about it. Think about how many things in your life that have happened that you would have never anticipated. Okay, now think about stocks. You've got so many things that can happen there that you just can't anticipate. What you do know is what the longer-term averages have been. You have to be careful with that. And you can, actually, one of the methods I saw that I liked the best was they took standard deviation or calculations, and they calculated basically the mean, that's an average. Over the past 5 years, they compared it to the past 30 years, and they basically went with the 5 year. And I really liked that. I like the fact that they went over what was happening more recently than taking the entire 30-year process. Still not perfect by any stretch of the imagination, but I think it was more accurate than using the 30-year period. And now if they're using the last 5 years, they're going to be, you're going to come up with a portfolio that's going to be mostly stock. And this is really interesting because all the software that's out there has kind of been ignoring what bonds have done over the past 5 years because the past 5 year return, not very good. Actually, for long-term treasuries, it's almost negative. Actually, yep. Hang on a second. 22. Yeah, it is negative. Holy cow. 5 year return on long-term government bonds is negative. Okay, so if you retired 5 years ago and you had long-term government bonds in your portfolio, you saw it go down, you saw it go up, and then you saw it give all the profits and put you back in the loss category. The problem is you were probably taking money out to supplement your retirement. That's a big issue. You can't afford to do that. That's one of the things I like about the fixed index products. The chances of people being able to generate that kind of stuff on their own at home are extremely remote. It's my opinion. The chances of professionals being able to manage the fixed income portfolio that's going to outperform that is minimal. Like I said, the Browns could go to the Super Bowl next year. That's the same level of chance that a professional manager has in the bond market of coming close to the long-term averages over the next 5 years. And I hope I'm wrong. I really do. I hope I'm wrong. But the odds are that they're not going to keep up with the returns on the fixed index annuity products. And if you want a link to a website so that you can go to the website, nobody's going to call you. Nobody's going to even know you're there. Turn your ad blockers on. And you can go to the website, put in your age, put in the amount of money you want to invest, and it'll give you a projection of what you could get. And every year that you don't take the income goes up. There's a guaranteed schedule for the first 10 years. After 10 years, it should continue to go up. They just don't guarantee that. The reason it should go up is after 10 years, you've got 10 years less of your life expectancy. And an annuity is like a reverse mortgage. They look at your life expectancy and how much money you put in and say, okay, we think we can pay this much a month. And the shorter that period, the more they can pay. So the shorter of a mortgage you take out, the more you have to pay, right? You take out a 10-year mortgage, what you don't even have. Take out a 15-year mortgage, your payment's going to be higher than a 30-year mortgage, right? Because you're paying it back over a shorter time period. If somebody's 80 or 75 and is taking out an annuity, the income that they can get, that they will generate, is a lot because your life expectancy. Now, I just had one of my great aunts pass away. She was 100. She lived to 100. I think she's the only one in the family that's done that. But it has not been uncommon for 87, 89. So that's a long time. But when you are at that point, let's say you're in your mid-70s, you can get a return that's going to be guaranteed, that's going to be incredibly difficult to match anywhere else. It's going to be incredibly difficult. And that's why I'm always saying, there is no one financial plan that you should have. There is a plan for you. It should be based on your age, your financial circumstances, and your tolerance for risk. Those are the three most important things that you need to take into account when you're doing a retirement income plan. Your current age, your financial position, and your tolerance for risk. And sitting down with somebody to talk about that, it's pretty easy for me to do it at this stage of the game because I've been doing it for 30 years now. But in fact, it really takes me more than a few minutes. Actually takes more minutes to gather the information than it does to do the plan. So anyway, feel free when you hear something like that and you want to say, Bill, I think I would like to take advantage of that. Okay. I've got this super simple little form. Just go to my website, request it, and then send it back, and I'll tell you what you could expect. No problem. There's no charge for that, by the way. If you like the work I do and want to do business with us, that's great. If not, hey, there's no obligation, and no salespeople are going to call because I'm the only salesperson there, and I have a hard time calling back the people who want to talk to me. So we're pretty busy. But I love it. It's great. And you have to, by the way, you have to be able to get to a point where you can say, okay, I get it now. I'm good with that. And that's the point that I would like to get all of my clients to. Now, most of them are there. And we've had these conversations multiple times. And when they forget, I just remind them. And they're like, oh, yeah. And I'm not going to announce what I'm about to do here yet, but I'm working on a special project, and it should help significantly. It should help people tremendously be able to simplify their financial lives a lot. And mine is super simple. I have a pension plan I contribute to at work, and I have my regular savings, and I have 2 bank accounts. That's it. That's what I got. Why? Because I am a minimalist. Extremely so. My house looks like a hospital. There's nothing in there that's not necessary. And at least, very little. And I've hidden that away. So you can't see it. But anyway, that's kind of how I like life. Simple. Especially when it comes to your finances, it is so easy to get so complicated so quickly that you just lose sight of what you're trying to do. And you don't need to make your life complicated. Life does that all by itself. You don't have to contribute to that effort. It's going to happen. But so we really have to work to try to keep things simple. The simpler they are, checklist type material. And by the way, I want to say thanks. I didn't ask for their permission to mention their names, so I'll have to hit them up this week with an email. But they gave me a book that I really like, and it was a book on checklists and how all these famous or extremely sophisticated people use checklists, and I think that's a great idea. Now that I hear the music, that means my show's over. This is Bill Bullington. I'm here every Saturday morning from 11 to noon. Have a good weekend, everybody. Good luck. Good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.